and go.
Hello, Warriors. We have the pleasure of talking to Andy Constant today at Damp Springs on Twitter. Andy used to be with Bridgewater. If you don't know who Bridgewater is, you probably have been in the markets long. It's Ray Dalio. And Andy had nothing but great things to say about that experience. And now he has a private Twitter feed that people are lined up to get on. So Andy, welcome to TradeGate Hub. Great to have you here today before Christmas.
Hey, thanks, Dale. Happy holidays to you too. I'm excited
Okay.
for the holidays, but we probably get some fireworks over the course of the next week.
Okay, so let's talk about that. The S&Ps have tried to recover. I have a negative view on the market based upon the elephant in the room, which to me is Apple. We take out 130 and 110 looks likely, maybe even 90 or 80. Looks like a descending triangle. So tell us what you're seeing for the rest of the year, which isn't that long, and more importantly, what the themes and narratives you're going to be trading off of going into 2023.
Yeah, so my process is about 3 months in timing. I do have some short-term views, and we'll touch on that particularly as it relates to year end, because there's going to be quite a bit of flow. But let me start with the high level of where I'm at. And I think David Tepper on CNBC actually he had his own independent views that are similar to mine. The basic idea, which is the markets to me are priced as, and you can see on this chart where we've had a significant increase in the value of what I call a sort of a 60-40 portfolio is one form of a portfolio. This is a portfolio of many more assets that better reflects the changes in financial conditions versus the 60-40, in that it includes commodities, gold, other assets. And so I look at this particular portfolio, I call it the DS beta portfolio, as consistent with whether financial assets are in demand or in supply. And I've had a few good calls this year going regarding the major impacts of quantitative tightening initially, and then a couple of over deleveragings that occurred that I called false dawns. And we're in the midst of another I think the second false dawn that I called in mid-October has ended. And we're now in this, again, heavy asset based on the following theme, which is even now, you look at the levels, portfolios for the year are only down around 12%. And that has limited wealth effect impact on inflation. And so what do we know? We know the inflation numbers are coming down quickly, but it's a question of where they'll settle. And so, and then the higher level idea is, do we need a recession to cause the inflation numbers to go? Has the Fed already overdone it in such a way that there's going to be an imminent recession? Or are we going to see a bounce or leveling out of falling inflation at a 4 or 5% level, which will result in a higher for longer strategy by the Fed, which is the one they ascribe to, but which the market is ignoring pretty much completely.
Yeah, they're already pricing in eases at the end of next year.
Yeah, exactly. And
right?
I'll show that on my chart when we
what I wanted to ask you, Andy, and this is a key question to me, because I follow sentiment closely, right? Yeah, you do too. And I just saw a chart of put call ratios way up there. A lot of puts being bought, and I think there is a shot to take out the October low, and maybe that won't be a false dawn down there. But that's become consensus view that we need the clearing event. We need the capitulation that we've never had, and maybe VIX even trades up towards 40, 35, breaks through 35 one time. Does it bother you that we're, have the majority opinion. I know it's hard for me, even though price action trumps sentiment and last week's action was so negative. How do you feel? Do you think we're going to take out the October lows and take out the second false dawn lows
Yeah.
that we had?
So I think the answer to that is maybe. Mostly I'm short now and will adjust my portfolio depending on the terms. I don't work with targets. I work with pressures. And right now, to me, the pressures are the market is pricing in what I would consider a soft landing, which is falling inflation, magically falling inflation, and very limited job loss. And I think that is, a possibility, but not what should be priced. And what should be priced is a sort of an averaging of a deep recession, a soft landing, or a stronger nominal growth because inflation stays sticky. And all three of those have different implications for asset prices. And the thing that's important is that the two extremes, where the economy is stronger than expected and doesn't land, or the economy is weaker than expected and has a recession, results in a tightening of financial conditions. And those tightening of financial conditions hurt asset prices. Now, a recession is bad for stocks and good for bonds, and higher for longer is modestly good for stocks, actually, because the nominal growth ends up staying high, but terrible for bonds. And so I'm short both because I don't want to bet on a soft landing. And so that's the big thing. And so I think
does today's GDP kind of tilt you in the direction that even if the Fed pauses, they're going to have to, say the 10-year pulls back to 270 or something like that, while stocks are falling? That maybe that's the hook, is that rates are coming down. It sure didn't help the market the last couple of weeks, and the dollar coming down didn't help the market the last couple of weeks. So could we have a bond rally with the market selling off?
Yeah, so I think if you want to bet on recession, which I think is a totally reasonable bet, I don't have a strong view of where we are. Whether it's going to be I have a strong view it's not going to be a soft landing, but I don't know whether it's going to be a stronger for longer or a imminent recession. But if you wanted to bet on that, I think the best trade to do is what I call the great convergence trade. And that is TLT ratioed with SPX. Bonds have significant, do you see that on the chart?
Right now it's blank.
Okay, let me reshare. Hold on. Are you there?
Yep.
Okay, hold on one sec. Still getting used to this screen sharing technology. Why am I not getting the screen on? Okay, hold on one second. Anyway, so the trade is to go long TLT and short SPX. And I think that ratio makes a great deal of sense because here you go. Because as you can see, do you see this now?
Yes.
So as you can see, we've had a pretty serious convergence in from October to now, but that sort of topped out. And so what I'm looking to do, if I want to bet on a recession, is start buying down around here. And so that's my view on that. Now I'm going to flip to something else, which is the SOFR pricing, because you mentioned that earlier, and to me, that is a alternative trade, which is, you see the on the SOFR futures. So that is June 23 to DEES 24, and shows that just after these CPI prints, cuts in 2020 from peak, whatever terminal ends up being, it's likely to be in in June. Cuts from there are priced, close to 200 basis points. Now they've bounced a little bit as the bond market has sold off, but that to me already signals that the market expects a recession, because in a recession, you might get 300 basis points of cuts in an extreme circumstance, but we're already priced 2/3 of the way there. So I look at this trade and say, stocks and bonds are not pricing a convergence where bonds outperform stocks. And so I might want to buy that. But I also can buy this at, buy June and sell DEES 24 at, let's say 180 basis points of cuts. And if I'm wrong on the recession, I'm going to be absolutely right on this.
Okay.
Where cuts. So those are the three things that I'm paying attention to right now. And again, it's markets are can price three. I see only three, and maybe I'm wrong, but I see only three options: recession, soft landing, or stickier inflation and growth that requires the Fed to not pause, or at least pause at a much higher terminal rate than is currently expected, and not cut like this.
Sequentially, couldn't we have both? Couldn't we have initially a growth scare early in the year? Okay, and the bonds do outperform stocks. And then after this, if we get another low in the S&Ps, begin to say that maybe that's the end of rates coming down, and rates may head up again, and we move right into that stickier, higher for longer, and the market is okay because there's still growth.
I think it's almost certain that you will get that sort of back and forth.
Okay.
I don't think it's clear that we're either 100% going into a recession or 100%. The only question is, can we get a soft landing where that sort of, you don't get any of those swings?
Well, can we put Captain Sully, make him the chair of the Fed, Captain Sully?
Yeah.
Because that's what it's going to take, isn't it? I mean, I'm hearing other people use that term, but I started talking about that 6 months ago. It would be a miracle.
To me, the reason why it would be a miracle is because the levers that the Fed has are so blunt, and the leverage of $6 trillion of money printing and $6 trillion of fiscal are so they're so flammable that the landing is hard enough in normal times, but now you're trying to land with a significant amount of gasoline lying on the runway, and any spark can cause one or the other non-soft landing extremes to happen. And so for me, what that just means is the Fed is either a recession is going to happen, and when a recession happens, bonds do well, but assets do badly.
Yes.
And so I like being short assets, or the soft landing ignites and they have to avoid the runway and stay higher for longer. And in that case, the Fed is aggressively tightening, and that's bad for assets. So I think it's easier so I agree there are going to be swings from growth scares to inflation. Right now we're in an inflation euphoric situation where inflation is going to be zero next quarter, next print, and everyone is convinced it's gone. Mission accomplished is the Fed.
How many times did that happen in the 70s where we thought we beat it? Was it 4 times, Andy?
So I think so it's very interesting to look back at that history. I can't count them. I think it's at least 4 times where you had pivots and then reverse pivots.
Right.
But remember back then, and I wasn't in the markets then, but back then, the Fed didn't just announced what its policy changed. There was no communication.
No.
It literally called the dealers on a trading morning and said, we've changed the funds rate, with no explanation. So it's hard to really look at that history.
Yeah, I know you're active in all spaces, and there's really been significant movements in the FX arena that I want to ask you about, most recently the BOJ, but we had the gilt crash and the pound crumbled to 103 before the recovery, and that was because of a dysfunctional gilt market at that time. And then I was asking an analyst about the BOJ move that we had this week, and why in December, without making any analogies to Pearl Harbor in December. But when you think about I asked him why December, and the JGB market had become dysfunctional. There was actually urgency to do what they did. Everyone thought they would do it eventually, but he felt there was urgency that they had to do it. So, despite maybe some trades on the long side of bonds, first Europe, then Asia, could that be, eventually coming to a theater near us here in the US in our bond market?
Yeah. So I've studied a lot about positioning of the major holders of bonds, particularly US bonds, and foreigners by and large, and the Japanese thing is interesting as it relates to foreign supply of held by Japanese people, which I think has put pressure on bonds. But the major currency manipulators or currency managers like China, their current situation is the dollar strength has sort of abated, and now they don't have to protect their currency. So they're more likely to be buyers of bonds than sellers of bonds. But then you look at banks, because banks are the US banks are a major player in bonds. And I don't look at the duration holdings of, so firstly, they've been selling their cash bonds significantly all year. They haven't been buying cash bonds, they've been selling. And their duration, as reported by JP Morgan's annual report, I've looked through everybody's annual report in the major bond holdings, they're all short duration. So and what I mean by that is they benefit from a position standpoint, not from a business standpoint, but from a position standpoint. They benefit from rising interest rates, not falling interest rates. So I've never seen a crisis where occurs when bonds rally. Now, sometimes bonds rally because of a crisis, but right. In terms of financial investors having some sort of margin call, it's very unusual that you have a margin call when bonds are rallying. It typically is because you've had some other
credit event or something.
Right.
Yes.
And so then I look at insurance companies and pension funds, and both of them are relatively unlevered. Pension funds by definition, and insurance companies tend to lever their bond positions less. And so we don't have the mechanisms. Now, I could be wrong, but I don't think we have the mechanisms.
Why did President Biden add $350 billion to the Teamsters union pension? If there's not an issue with shortfall, it's like the bonds were the worst crash this year, worse than equities.
Absolutely.
And so the tide went out, and now we're seeing what people had to do because of financial repression and go out on the risk curve, especially pensions, to generate 8% returns in a 0% environment. Do you think might be you feel they're unleveraged, so
I feel like there isn't a HDI problem in the U.S. markets, and that banks in particular. So I don't think so. I could be wrong, but that's my study of those investors indicates limited pain. And one of the best ways to look at that is the relative outperformance of life insurance companies that are public. Yeah. And you'll see that the market is not sniffing out pain in public life insurers, and they usually are pretty good at that. And so perhaps there's something else there, but neither the market sniffs it nor my analysis indicates that there's significant leverage that a bond rally would uncover. Now, a bond sell-off, that's a different story, but people are well positioned, like banks in particular, are very well positioned for a bond sell-off.
Okay, so that's not going to happen right away. Let me ask you about what's been happening with the dollar in relation to the commodity market. Crude has bounced from 70. They didn't fill President Biden's limit order at 65. And we've had huge runs in silver outperforming gold, threatening major breakouts. Is that going to be part of the equation in 2023 to own shares of things that if you drop it on your foot, it hurts?
Yeah, so I have a bullish position in oil. I like the idea that there's this demand. Clearly, in a recession, that position will suffer. A deep recession, it'll suffer quite a bit. Now, that said, there is this SPR rebuild, which, call it what you will, whether you like the SPR or not. Right now, the guy's got a lot of money in that trade. So if he does end up successfully covering down, that's been a pretty big success, whether you like it or not.
Yeah, it has.
But in a recession, that trade is not going to work. So you have to, but I do like commodities broadly. As it relates to precious metals, I trade precious metals as an asset, and I have a short in all assets. So precious metals are one of those assets.
Okay.
And that one hasn't worked. It's basically flat on that graph I showed you. It's the only one that hasn't made me money. I look at I look at gold as being Fed credibility, whether it's going up or down, not the level, because there's a big debate about whether the Fed is credible or not credible. And I don't want to be in that debate. Okay. It's really about whether credibility is rising or falling. Now, if the Fed is credible because it's able to kill inflation with its policies, it's hard to see gold rallying a lot. At the same time, if the Fed hasn't done enough, gold is going to rally.
Okay. All right. So, why don't we talk about how people could look at your narrative for 2023? What do you think? You're going to have to be very tactical in 2023 because there's going to be a lot of shifts in, your stock to bond ratio. What else should we be paying attention to going into next year, Andy?
Right. So I think there's going to be a period of, right now we're in a world in which this idea that the Fed's terminal rate is going to be as high as they expected and that they're going to pause as long as they expected is not being believed. I think it's more likely over time that they're going to be more believed than not believed than is priced. So I think that's the short-term theme, which is tightening financial conditions and a rally in this graph that's on the screen, where less cuts get discounted for the near term. So that's my high-level outlook in the next 2 to 3 months. Now the data is going to be weak coming out of Christmas, and when it is, this number could actually drop down to my target of 180. But I think that's probably my favorite opportunity right now, is to begin fading this idea that the Fed is done at a low terminal rate and a heavy and aggressive cuts beginning in June.
Okay. Appreciate that. And I know that you have a Twitter feed, you have a free feed, and do you have a newsletter, or is it all done by private Twitter feed, Andy?
Yeah, so my primary business is that I have a client, many of the major macro hedge fund clients. You
consult with them?
I consult with them and offer newsletters, research, and direct one-on-one. The private Twitter, so most of my work is available at dampspring.com with a small delay from what I offer to my paying clients. And so you can see pretty much all my work going back as long as, almost 4 years that I've had this business, with a couple of weeks delay from what my clients get at Damp Spring and my Damp Spring Report archives, which is a newsletter. And then I offer a private Twitter that allows for, a very small set of people. I don't want to dilute my value to them to, have pretty much constant one-on-one dialogue and group dialogue regarding what my thinking is. And they have access to the real-time damp spring report that my hedge fund clients do. Currently, I'm full. I have a 200-person waiting list. I'm not expecting to expand that in the near term because I can't dilute it for my existing clients. But sign up on the waiting list at dampspring.com if you're interested. And, that does move a little bit.
Maybe I would be able to get on by the time I'm 80.
Yeah.
Huh?
I don't know. Is that must be like 30 years for you.
Oh, thank you very much. I appreciate that, Andy. Anyone who's watching this live or watches a video, it's very important to have, read from smart people. And I've seen Andy nail some turns in the market. That's why I brought him here. And I would include him in my intelligence gathering. So, Andy, I want to wish you a Merry Christmas, you and your family, and a great end of the year and first quarter. And hopefully we could keep the dialogue going because you add value to everyone who hears you.
Dale, I appreciate it. Merry Christmas to you and Happy New Year. Look forward to talking again in the future.
All right, Andy Constant, everybody. Follow him at Damped Springs on Twitter.